Okay, hey Megan, welcome to the Olympia Real Estate Podcast. We've been joking around a little bit, but let's try to kick off some sort of an intro here. We have a couple of topics to talk about today, but first off, how are you doing today?
Great. How are you doing?
I'm just doing fantastic. That's it.
Good.
Okay, so one of the things that actually we wanted to talk about today, Fannie Mae came out with a 5% down multifamily loan product. So you can buy 2 to 4 units with only 5% down. Previously, it was 15 to 20% down, or obviously more. The only catch here is you have to live in the home. Previously, your only option to do this with a low down payment would be an FHA loan, which has different mortgage insurance and some other requirements. So to see this on a conventional loan is actually kind of cool. And in a market right now where we're seeing this, it is cool to see that some of the entities are responding with loan programs that can actually help the average buyer. And this is a program where obviously we've seen affordability be impacted with the rise in interest rates. So going to multifamily, where you have rents coming in, or maybe you have other family members living with you in these other units, can really help make that more affordable.
Well, and the lending restrictions, with an FHA loan, they're going to be much more nitpicky about the condition of the building, whereas conventional, they're a lot more lenient about various things. Like, for instance, FHA might call out a roof that doesn't have a full lifespan or a heavier lifespan on it. Conventional doesn't really care so much. They might call for a roof cert if it's nearing the end of its life, but you can get away with a lot more things with conventional than you can with FHA.
They do tend to be a little bit more lenient, and the conventional loans, specifically right now we're talking about Fannie Mae, they also have a more favorable mortgage insurance. The rate tends to be a little bit better for the mortgage insurance, and it's removable. So if once you get to the proper loan to value or the proper equity position, you can refinance out of that mortgage insurance, which you cannot do on an FHA loan, where that's there for the life of the loan.
Yeah. I mean, Jason and I are always trying to tell buyers, especially first-time home buyers, try to move them into that multifamily, because if you can you're getting 2 for 1, essentially. If you can get into a multifamily property and have the majority of your mortgage payment covered by the rents from your other unit and live there for a year, or intend to live there for a year, I mean, what better way to create wealth?
Well, and this really goes to the person that maybe wants to be a landlord. And a great way to structure this would be to do it a couple times in a row. If you live in the property for a year, you can then go buy another multifamily, live in that property for a year. Nothing happens to your existing mortgage when you move out. That still stays with its original interest rate, does not become an investor's loan in any way. You keep your original loan on there, even if now for you it's an investment property instead of a primary. You just keep that original closed loan on there, go buy a new primary, live in that for a year. Now you're on your second income property, and you're starting to build that empire.
Yep. What better way to build wealth?
And then you can refinance those to manage your payments down the road if rates fluctuate or get better.
Yeah.
Or if you can get rid of that mortgage insurance, or if you need to pull equity out, you could do a cashback refinance or a line of credit and really open up some options for yourself. But not everybody wants to be a landlord. And so you do have to take those considerations, that you do have to take that into consideration as well.
Well, I mean, if you don't want to be a landlord where you're managing your own properties, then you can hire a property manager to do it for you.
Yeah, so you deal with that. What's your experience and the difference between managing a property yourself and having a management company take care of tenants for you?
We haven't had any property management companies take care of tenants for us. So there are times where I do think that would be worth whatever the cost is. But for the most part, we just manage our own. And it's not, we keep a good relationship with our tenants. So if they call us, we come and do whatever repairs they need.
And so you have the skills, you and your partner, to be able to go and do most of the maintenance or just hire out the bigger stuff, plumbing, electrical, stuff like that.
Yeah. Well, no, we even do the plumbing and electrical.
Oh, wow.
Yeah.
Awesome.
Yeah. We don't do drywall.
Okay. So it's great that we are seeing new programs coming out from Fannie Mae, because this actually is it's a pretty big change in the landscape of home financing.
Yeah.
So it's great that we're seeing that, because the rest of what we're seeing in the market is, I hate to say more of the same. It's a bit monotonous, but prices have normalized somewhat. Rates, I think, I don't want to say rates are ever normal because they change every day, but they're kind of in this territory where they've been hanging out in the upper 7s and now dipping into the 8s for some people.
Yeah.
And that's the reality of what we're seeing. What are you seeing out in the market with homes that you're listing and homes that you're helping people to buy?
The same. I mean, the good thing, so many people are like, hey, I'm going to wait till the rates drop. Well, let's talk about that. Do you really want to wait until you're competing with everybody else to get the same property? Because then what happens? Then the prices go up and then you've got that stress and you're paying over market. No, if you can afford it, do it today, because the reality is we don't know where rates are going to go. We can all sit and speculate and say, oh, well, all of the statistics say, well, the rates are going to go here, they're going to go down. We don't know what's going to happen. So if you can afford it today, do it today.
Yeah. Now I'd think you can always make your scenario better,
Mm-hmm.
but you're going to be locked into whatever your scenario is. So if the market gets worse, you're locked into what you've got.
Yeah.
If the market gets better, you can chase that down with a refinance, or there's other opportunities that will be available for you from that equity position. So that's a really powerful way to get into something now.
Mm-hmm.
All your professionals, title people, insurance agents, mortgage person, real estate person, we have time to call you back right now. Let's work up a deal without the crazy hectic frenzy.
Yep.
Then when you do that refinance in the crazy hectic frenzy time, you're like, hey, I don't have to deal with the seller.
Right.
I'm just myself. I'm going to do my refinance on my own time frame.
Yep.
And then you have that's a way to really manage your money properly and say, hey, if I want to purchase a home, let's go get the asset and then manage it. It's just like the stock market. You dollar cost average over time. Go get some assets. And then if you need to, sell those, you can. Don't try to time the market.
No.
I think there's actually something I was watching recently about the stock market. If you tried to time it right, how hard it was, and how like 11 of the best days where you got all your most return happened right after the worst days. And if you would have tried to play it, you would have ended up exponentially worse.
Yeah.
And I think the same is true for the housing market. Focus on your need for housing. If you can do it for investment purposes, then you're kind of at that next level, I would say. But always remember it's an asset and a place to live, and it's going to have its value for that purpose too.
Yeah, absolutely. There's only so much, there's only so much land. Get in while you can.
That's right.
I mean, your money's obviously, it's not really growing if it's sitting in a bank account right now. So put it to work. Buy some real estate.
And there are a lot of tools out there to make the payments more affordable. I've got into a tiff on a Facebook thread about whether or not buy downs are relevant. You can do temporary or permanent buy downs. On the temporary buy down, there's more details. I don't know if it's really relevant to go into here, but your upfront fee is the same as the savings you're going to get. So to me, it kind of seemed like 6 of one and half a dozen of another. But really, it does make the payment more affordable for a time frame. You could get a seller to pay for that reduction in your initial interest rate, and that could still be a value for managing your cash flow.
Correct. Yes. That's the key right there, is managing your cash flow. If you are somebody who's able to manage your cash flow, it might be worth looking into. I've never written one into an offer. It just has that I just haven't had the opportunity to do that where that was the best fit for my clients. I have thrown it out lots of times though, because that's what I do is I educate my clients on every option that they have and then let them pick what's best for them. But I haven't used the 2-1 buy down.
I have experienced the same thing, and there's all sorts of ways you can spend a seller's money if you get concessions. You have normal closing costs. You have permanent buy downs if you want to look at that, which in this market may be pretty questionable. But I would really look to see that seller is paying all my normal closing costs and reducing my cash to close. And ideally, I would love to go in on a purchase with just my down payment.
Yeah.
Wouldn't that be sweet? And if you can get more, maybe you can get a buy down on top of that. That would be really sweet at that point. But if a seller is doing a buy down, they might be willing to do other things, because I'm not sure the seller cares how you spend their money if they're offering you a credit.
Right. Yeah.
Buy hot dogs or hamburgers, it's no difference to me.
Right. Exactly. Yeah. To them, it's less money in their pocket. So where it goes, most of the time, they don't really care.
And so let's switch topics, I guess, a little bit more to the listing side of things. Something that I've seen is that homes that are sold, that are selling, seem to be the ones that are listed outright, and then they're moving quickly, versus the homes that are having price reductions and other things. So there's going to be a big difference between listing for market and listing for what someone thinks that their home is worth. But what are you seeing out there as far as how to get them priced right? And are people having to make big discounts? Are they really raking in over asking, or what's the landscape out there from your perspective?
No, some properties are moving really fast. But the majority of them, it's kind of the average 45 days or so, depending on the price point. I mean, I just sold one last week or the week before that had been sitting for like 70 days. We got a pretty good deal on it. but it was just sitting. So unfortunately, people are afraid of what the interest rates are, and they think, I'm going to wait. I'm going to wait for the market. If you are a wise, savvy investor, you get in now. If you can afford it, get in.
So for those people you've seen that are nervous about rates and maybe hesitant, how do they compare to the people that are still, the people who are closing? Are they still excited, or they're like, oh man,
no.
I just bought a house, it sucks?
No, they're thrilled. I mean, thrilled because there's no competition, or there's very little competition out there. The nice thing about this market is that you have the time to actually search out what you want, and you don't have to do everything right now. You have the time to go and look at a property, actually think about it, take a day or two to run your numbers, make sure that that's a good fit for you before you write up an offer. Like, this is a huge investment. This is a huge leap, especially if you're just getting into, this is your first purchase. You need to be able to think about that and make sure that that's something that you're comfortable doing.
Yeah, and that's a big factor, because I've had people that I met when rates were crazy low, and if you're just starting, you don't know what landscape you're in, whether it's a good deal or not. You kind of have to base this off of, are you ready to purchase or not? And I've seen some people miss deals because they weren't ready, but they needed more time to gather information and get familiar with the whole process. So really allowing time for that is crucial. And then maybe you can try to time the market a little bit if you really need to, but I still think do it if you can, manage it afterwards.
Yes. Yep. I'm right there with you.
So going into the winter and coming up on an election year next year, what kind of outlook do you have? Do you think things are going to stay the same until they aren't, and that's just as good as we get for a prediction? Or do you have any further insights beyond that?
I've heard a lot of people say, well, coming into an election year, the rates are going to drop because they always do. It's possible, but it's also possible that maybe they won't. I don't really try to time the market because I can't tell the future. So
your outlook, and I think resonates with mine, is to like kind of wake up every day and take it as it comes.
Yeah.
And try to do the best with what you have in the scenario you're in.
Yes.
Yes, planning is good.
Yes.
But in real estate, it's probably a shorter planning window.
Right. I mean, knowledge is power. So if you are interested in buying and you're not sure if maybe now is the right time, the best thing you can do is to get in touch with a professional. Let's run the numbers. Let's see where you're at right now. And if there's some things you need to work on, or some money that you need to save up, or some things that you need to pay off, well, let's set a goal. Let's say, you're not sure about right now, but maybe in 6 months you want to buy. What does that look like? Well, let's come up with a plan so that you're prepared. And in 6 months' time, you're ready to go and you're excited because it's something that you've been working for.
And then you can go through the process swiftly rather than in a frenzy, like I was kind of alluding to earlier.
Right, with the uncertainty.
So I think that's kind of a main fundamental. And if you always go back to fundamentals, you'll be safe. Do what you can afford when you can afford it. And don't base too much of your decision today on what tomorrow might hold.
Yes, exactly.
Okay, great. Well, thanks for stopping by today. Yeah. It's always a pleasure to sit down and chat, and I'm sure we'll get another chance here soon.
Awesome. Thanks, Jeff.
All right. Hey, Megan, did you hear?
Great. Now what?
Did you hear the one about Fannie Mae?
Oh, no.
They're now allowing multifamily with 5% down, but you have to live there.
Oh, my God.
Oh, I don't know why I'm laughing so hard.
I don't either. I'm feeling weird about things.
I'm thinking about too many steps of the podcast at once. I'm thinking about editing it while I'm doing it.
Well, I mean, we could just start with, hey, let's talk about this, headline of Fannie Mae accepting 5% down, as opposed to 20 to 25% down for multifamily.
Yes. So Fannie Mae is with it. They're hip to the program and the economy. And they're like, hey guys, we get it. It's tough out there. 15% down is too much for multifamily.
Yes.
How about 5%?
Yes. Perfect.
Okay. I don't know where that came from.
I love that.
Goofy.
Yeah.
Okay. Hey, Megan, welcome to the Olympia Real Estate Podcast. We've been joking around a little bit, but let's try to kick off some sort of an intro here. We have a couple of topics to talk about today, but first off, how are you doing today?
Great. How are you doing?
I'm just doing fantastic. That's it.
Good.
Okay, so one of the things that actually we wanted to talk about today was
I don't even know it's funny.
I don't know either. I'm so professional.
Yeah. Me too. Obviously.
That was weird.
Because it was so short.
Oh, you're great. Well, we got 22 minutes of film, but I'm not sure how much of that is
Laughter.
me just absolutely losing it.